very good evening and welcome. You're watching the India Development Debate with me, Tamanna Inamdar. The big news this evening is the SEBI board meeting that has ended just a short while ago, in which the big headlines coming out is SEBI approving the reduction of listing timing of IPOs to 3 days from 6 days earlier, that is from the last day of issue. So that's the big one coming in. Additionally, SEBI has also approved additional disclosure norms for FPIs. So they've made those pretty stringent for FPIs. Identification and disclosure norms for large investors and foreign portfolio investors will be made more stringent. SEBI has also approved the strengthening of investor grievance handling mechanism through scores. Ankur Mishra is joining us for more details on the phone. Ankur, what are the big highlights coming in at this hour, and what has been left off the SEBI board meet which was being expected? Ankur, can you hear me?
I will start with the bigger headline, which is the reduction of timeline of listing of shares in public issue, and that has been reduced from T+6 days to T+3 days. Now I'll go into the details. The application has been made voluntary from September 1, 2023 and mandatory after December 2023, meaning if any of the issuers want, they can apply it by 1st of September 2023. The benefits of this will be that the issuers will receive their funds to allottees, and that will happen in a shorter time period. Apart from that, it will also help in keep of securities, if any, will be curbed. Apart from that, if you see the major announcement that has been on the FPI front, now this is something which has come into the limelight after the Adani Heidelberg issue, and after that, SEBI had released a discussion paper on stricter norms for FPIs. As we speak, SEBI chairman is walking for the press conference, and we will ask what are the issues which has been left out, and the major one has been the TER issue on mutual funds, which has not been approved by SEBI board. Apart from that, there are also a contentious issue on the onus of putting on who will be responsible if there is a problem in a scheme or so.
SEBI
press conference is about
it's about to start. I can see those live visuals there, and I know you've hopped out of that room just to take this call and give us this report. So thank you for that. I think you better run as we wait for SEBI chairperson Madhabi Puri Buch to start her announcements. Let's cut in.
This long. We had quite a marathon board meeting, lots of agenda items. We couldn't even finish. We finally had to defer some items due to lack of time. So my sincere apologies to keep you waiting. I thought maybe we'll just do a press release and we won't do the press meet, but I think you're opted otherwise. So we are happy to do that. So what I will do is, you've seen the press release. What I will do is, like always, give you a very broad overview of each of these items to share the regulatory intent and regulatory thinking behind each of these items, and then we'll move quickly on to question and answers. So T+6 to T+3, this is again one of those global firsts, I think. We will do the benchmarking and validate that, but like we moved into T+1 settlement for secondary market, and it's something that most jurisdictions are yet to implement, and they are they've been extremely complimentary of the fact that we did that without any glitch, any problems in terms of transition at all. We are very confident that similarly this T+3 will also happen without a glitch, because all the market participants involved, whether it is the exchanges, clearing corporations, the bankers, the RTAs, everybody has actually done their testing and their stress testing to figure out that they will actually be able to meet all the timelines that have been now put down. Overall, I guess what we're really pleased about is that what this will result in is that the issuers will get their money quicker, the investors will get their shares quicker, the those who didn't get allotment will get their refund or the unblocking quicker. So at the end of the day, time is money. So with this process, we will be giving to all the market participants lots of money in the form of 3 days. Item number 2 is in the area of listed debt. Here there are 2 provisions which are in some way linked. The first is in respect of if an entity has a listed paper, then subject to some provisions and some exemptions, the regulation will now be that all the paper that they issue would need to be listed. The reason for this is that, as you know, the bond market is not very liquid, and price discovery and valuation happens based on not just the trading in that particular, in the paper of that particular issuer, but also in terms of the primary issuances done by that issuer. And therefore, the transparency on what was the latest primary issuance done by that issuer becomes very important for price discovery in the secondary market. So that has really been the driver of this proposal. Having said that, so what they will really be required to do, and in any case those issuers are complying with all the regulations because they have one listed paper, so they are anyway complying with all the regulations. The only additional requirement from them will be in terms of transparency of the structure and the terms of the what so far was unlisted debt issuance. So that is something that will help to improve price discovery in the market. Linked to it is the issue of voluntary delisting, because when we got feedback from the market, as you know, we do very extensive public consultation. So one of the feedback that we got was that there may be some entities who do not really have plans of a lot of issue raising and raising of funds, and they were a one-off issuer, and they may not want to remain listed. So is there a mechanism for them to delist their bonds and be able to then therefore not have this requirement of continuous listing? So we have facilitated that, again subject to some conditions and some requirements. Number 3 is the enablement of direct participation in the Limited Purpose Clearing Corporation. In the last board meeting, the board had approved certain provisions for the Limited Purpose Clearing Corporation. As you know, this is the clearing corporation for the corporate bond repo market. So this, as you would recollect, is really a very important institutional building block for the bond markets, because if we are trying to encourage liquidity in the bond market, that can come only through market making, and market makers will have a viable business model only if they can have access to low-cost funds for their inventory, and that can only come from the overnight market in terms of the corporate bond repo market. So as a result of this, this last time we had done, there are 2 modes by which people can participate in the LPCC. Because this is an overnight market, the timeliness of being able to lend and borrow money is very important. So people would want as long a period to have flexibility in terms of being able to do the transaction, but they would need to have the settlement as quickly as possible so that they have access to funds. So for that, direct participation by the clients in the LPCC is quite crucial. So today the board approved a mechanism which would enable that to happen in order to facilitate even greater participation in the corporate bond repo market. The next item is in respect of REITs and InvITs. As you know, SEBI considers this a very, very important channel or a very important product through which capital raising can be done in our markets. We think there's a huge potential both in terms of our infrastructure space as well as the real estate space. And we found over the last many months that there is a very significant interest from capital providers, including overseas providers, in these vehicles. So what we have really done is we have introduced the concept of, so first what we have done is we have brought in a minimum unit holding requirement by sponsors. Reason for this is really very similar to the concept of skin in the game in mutual funds that we have. So the thought is that since the sponsors play a very active role in the REIT InvIT structure, very often they are the ones who are the promoters of the investment manager or the project manager. They actually are the operating entity for the operating asset. Therefore, for them to have a skin in the game beyond the 3 years that we had currently stipulated was important. However, again, based on the market feedback that we received as part of our public consultation, we got a lot of feedback, and we have therefore created the concept of the self-sponsored investment manager, which means that if an original sponsor wishes to have 100% monetization and to exit his role as sponsor, he not only will anyway have the option of finding another sponsor to come and step into his shoes. That was an option that was always available. But now they would also have an option of the investment manager itself being a self-sponsored investment manager. So this is additional flexibility which has been offered to the industry, and there has been a very positive response to this flexibility. We then move on to item number 5. This is also something, again, which is in response to the need of the market. As you know, REITs and InvITs are very long-term investments, and they tend to be big, bulky investments. They're not a very diversified set of assets. And in that context, the unit holders felt that there was a need for them to be a part of the decision-making process of the investment manager, particularly because a large number of transactions do tend to happen as related party transactions with the sponsor, because the whole construct is that the sponsor is really monetizing his or her assets. So a large part of the assets that are purchased by the REIT or InvIT actually belong to the sponsor. So in a way, it is a related party transaction. And on an ongoing basis, a lot of the management of the asset is done again by the project manager or the investment manager, which is again typically belonging to the sponsor. So in this context, in order to give a uniformity of rights to the unit holders, what we have proposed is that anyone who crosses the 10% threshold of unit holding has the right to nominate a director. Of course, they may choose not to exercise that right. And even people who are below the 10% threshold can get together and nominate a person. But naturally, this person would need to be fully empowered by the investors who are nominating him or her, because there are very often confidential deals, there is confidential information, timely decision-making. So it is envisaged that there would be some form of power of attorney. So if 3-4 people together have 10% and are nominating somebody to the board, they would effectively give a power of attorney to this person to represent them on the board. So this would ensure that there is a certain parity and uniformity of nomination rights on the board of the investment manager. The next one is in respect of additional disclosures from FPIs that fulfill certain criteria, certain objective criteria. Here, the essential driver and the regulatory intent really is that there is a possibility that if there is a layering of investments across various FPIs and deeper layers within the FPI, then it is possible that the people who are actually the economic interest holders of the FPIs may be, on an aggregate basis, may be holding enough percentage of the shares so as to either trigger the minimum public shareholding regulations or the SAST, which is the substantial acquisition of shares and takeover regulations. So one of these two, there could potentially be a violation which would need to be examined if, so the granular information would ensure that this violation does not happen. Also, we were concerned about the possible misuse of the FPI route to circumvent requirements of Press Note 3, which, as you know, is applicable for FDI investments. And so all of these things put together, we have come up with the proposal, broadly speaking, for two categories of FPIs. One category is that which holds more than 50% of their Indian equity AUM in a single corporate group, Indian corporate group. This is the first category. The second category is where FPIs, and as some of you may be familiar, there's a concept called FPI group. If they together hold more than 25,000 crores of equity AUM in the Indian markets, then we consider them quite significant. And so this would be the second category. However, not all people who
Yeah, some important development coming in as far as liberalized remittance scheme, that is LRS and tax collected at source are concerned. The Finance Ministry has come out with the details, which is with regard to liberalized remittance scheme and tax collected at source, that is called TCS. Finance Ministry has clearly said that there are no any changes that is going to be made in TCS for all purposes under LRS and overseas travel tour packages, regardless of mode of payment for amounts up to rupees 7 lakh per individual per annum. So the revised rates will be same. There will be no changes at the Ministry of Finance after consultation with all the stakeholders. The second important announcement that has been made by the Ministry of Finance that since they were also in the consultation with banks and the banks have reported Finance Ministry that their IT system is not capable at this point in time to implement a revised tax system when it comes to LRS, TCS under LRS. So taking into consideration, government has decided to provide more time for implementation of revised TCS rates and for inclusion of credit card payment in LRS. And for that, it has been decided that the increased TCS rates will now be coming into effect from 1st October 2023 instead of 1st July 2023. These are the changes that has been made, and the Finance Ministry has come out with the details. Back to you.
He still agreed, which means 4 levels have really gone against the investor or in favor of the intermediary. Then it will need to go into an arbitration mode. And because these new ODRs are there, they are much more cost effective for the investor as compared to the traditional modes. But of course, the investor would still retain all his rights to approach any other forum as he may want to do for the purpose of his grievance redressal. So that was also approved by the board, and of course our annual report and our annual accounts were also approved by the board. So that's where we are.
Thank you, ma'am. We'll just call one by one. Yeah, Menaka, you can go first.
Hi, good evening. I have questions mostly to do with the enhanced disclosures for foreign portfolio investors. And I have 2 or 3 different questions all related to each other, so I can put them to you all together. First, I'd like to get a comment from Sebi on the timing for this change. Why have you decided to review disclosure regime for foreign investors at this point in time? What was the potential trigger? And what are you hoping to achieve through this? That's one. Second, whilst I understand that this applies mostly to foreign portfolio investors, the same could be achieved through classes of domestic investors as well. That is the violation of MPS or SAST. Are you looking to seek any kind of further enhanced disclosures within other asset classes besides just the foreign investor class? That's the second. And the third bit I wanted to ask was whether in any of the responses you got to the discussion paper, there was any significant pushback from the foreign investor community on this enhanced compliance that they have to deal with, or any expression of we will not be able to do this because of secrecy laws across the world, etc., etc.? Thank you.
So I'll take a couple and I'll hand over to Anant. So in terms of the timing and the trigger, this issue of FPI beneficial ownership and the implications for various regulations of ours is an issue which is about a year and a half old. So if you were to be a fly on the wall and be able to fly down onto that file, as you know in the government we have files, you will see that the first paper on that originated about a year and a half ago. And this has therefore been in discussion both internally and externally. And it was something that we felt the need to do. And we think that these two issues, which to us are important, MPS, SAST, and of course the issue, the larger national issue of Press Note 3, and therefore it has manifested itself at this stage, but this was triggered and the file originated about a year and a half ago. In terms of domestic investors, the point about it being equally applicable to domestic holders is true. However, the big difference is that if an entity is registered in India, the powers that SEBI has in order to be able to access the information about the holdings and be able to go behind each layer of the holdings is high, because all the data resides in our country and SEBI has the powers to call for them. Whereas when it comes to the foreign entities, there are limitations on what SEBI can do, whether it is on its own or whether it is under the MMOUs that we sign with ISCO and under which there is multilateral collaboration. There are certain limitations to that access to that information, and therefore it becomes necessary for SEBI to stipulate this upfront at the start itself, so that the rules of the game are very clear and people know and understand that they're going to have to give this disclosure, irrespective of which jurisdiction they are coming from. In terms of the feedback from the market, Anant will take that.
Thanks, ma'am. So, short answer, Menka, to your question, no real, substantial pushback to the proposals that we saw. We did hold a lot of suo motu consultations with many FPIs. Many stakeholders also reached out to us and gave us feedback. I think we got about 35 sets of feedback, formal feedback. There were some questions about who would, how would you decide the exemption categories that the chairperson referred to? And we actually learned from those interactions. The broad process that we followed was the following. We were very clear that we understood the fact that what we were asking for could be very onerous for some of the large FPI, and that could come in the way of ease of doing business. So our intention was to try and reduce the type 2 errors, where we ask people who are actually doing a good job, not really doing anything bad. We wanted to spare them the effort of having to give us a lot of unnecessary compliances. So we wanted to reduce that. At the same time, we didn't want to increase type 1 errors, where people whom we wanted to sort of get more disclosures from actually got around it by way of the exemptions. So the discussions that we had with the FPIs helped us do both. As Chairperson mentioned, therefore, the actual potential target list, which might have to give us more disclosures or bring down their positions, came down to a very, very low number. So that kind of helped in the whole process of therefore reducing the amount of potential noise which could come from FPIs. You've picked up your mic, but let me just complete the point. On the contrary, from some of the constituents and stakeholders, we actually got feedback saying not only do they support the proposal very wholly, but they would actually also like to make it tighter. So for instance, the original proposal that we saw in the consultation paper was that existing FPI should be given 6 months to bring down their positions, and that new FPI should be also given 6 months to, stabilize their positions. In the final proposal, we brought that down to 3 months each, which means that the existing FPIs will now have 3 months to come down below 50% concentration in one group or less than 25,000 crores. Thereafter, they'll have to comply with the additional disclosure requirements. Likewise, for new FPIs, it will be 3 months from the time of the first trade as opposed to 6 months from the time of registration, which was proposed in the consultation paper. So a lot of healthy discussions. We also learned a lot about, how we could come up with objective exemption clauses, which would reduce the regulatory burden. And overall, the feedbacks, including from associations that represents FPI, seems to be reasonably positive.
Sorry, I just have one follow-up, very tiny question. I won't take more than that. So you said that the number of funds impacted in either volume or amount have further reduced based on your understanding? I mean, you put some numbers in the consultation paper, I recall.
That's right.
Is the affected subset smaller than that now?
We sense that it will be a little smaller than that.
Okay.
At this moment.
Yeah.
Thank you.
Yes.
Hello, everyone. Ma'am, you started by talking about how you literally fell short of time and a lot of proposals had to be deferred. I just wanted to understand, I mean, the whole proposal on the total expense ratio regulations for mutual funds, in what category does it fall under? Was it that it had to be deferred because of time, or was the resistance stronger than your commitment to bring this particular regulation?
Oh, the answer to that one is very simple. So this was not due to paucity of time. This proposal was discussed in depth, and the board finally advised SEBI to go back and publish it as another consultation paper. Reason being that, as I had mentioned earlier in some forum, that unlike our normal proposals which are done by way of co-creation with the industry, since this was a price-sensitive subject, we did it with the limited data that we had and without the benefit of the data that the industry had. So once our consultation paper was there, then naturally industry came back with their granular data. And for instance, as an example, I would say, for instance, they demonstrated to us that the economies of scale over the last 5 years, which we were seeking to share with the investors, actually happened. Now, when we saw that granular data and said, okay, we now understand this, so therefore, a lot of the things that we had built into and baked into our original proposal needed to undergo a change. Similarly, there was a lot of discussion about arbitrage funds and how they, by definition and by nature, have a lot of transactions, right? Because you're doing buy, sell all the time. Of course, on the other side, you don't need that much of research going on in an arbitrage fund, but the data came to us. And as a result of this data, which came to us from the various stakeholders, we modified the proposal, and the proposal was actually, I think the industry would be quite pleased to see the new proposal. And therefore, what the board said was, look, the proposal has undergone significant change because, as we described, we had more data, new data, and therefore we, obviously, as I've always said, that the data will speak. So our policies will always rely on data. And therefore, the board advised us that publish your new proposal, which you have put to the board, publish it again to the industry, and let us see now with this fresh proposal, which is quite different, let's see what the feedback is. So that is why.
By when do you expect this new proposal to essentially...
Soon, we will, in a few days, we will be doing that.
Okay, as far as the cap itself is concerned, I mean, what could be the changes on that front?
Sorry, on what front?
On the cap itself. GR cap.
Yeah. No, so you'll need to wait until you see the new proposal. So you'll need to see the new proposal. We'll be publishing it soon, don't worry.
Yeah. Sammy from Business
But I
Standard.
told you the industry will be quite happy, right? So, as I said, we've taken the data that they had. We saw that it was credible data, and we've modified our proposal. So the industry should be quite happy, we think.
Sammy from Business
Yeah,
Standard.
my question is around this FPI disclosure tightening. So, like you said, implementing this would have been easier for domestic investors. But if you have to implement it on FPIs, are there any treaties where they can, seek some sort of exemption from what SEBI has proposed?
So that is the whole thing, that as you can understand, there are some laws of the land, right? And depending on the jurisdiction, that's a question of law of the land. But here, this is a explicit regulation which, by coming into our regulatory purview, they are accepting that regulation. So, in a sense, it's like, I won't call it a contract, because obviously a regulator doesn't enter into a contract with somebody, but I'm saying ultimately it's like a contract, that it has the flavor of a contract to say that now if I'm coming into this regulated space over here as an FPI, I'm agreeing to these terms. So now whatever may have been applicable based on my domicile and my jurisdiction will no longer apply because I'm agreeing to this. So which is why the need for a regulation change, so that it becomes explicit and that people are voluntarily coming and saying that if I want to be an FPI here, I understand that I now need to comply in case I breach these limits.
Ankur. Hello, ma'am. Ankur Mishra from ET Now. Ma'am, my question is regarding the registered investment advisors. Recently, there were representations which were made by them regarding the new advertising code. And also a related question, ma'am. Recently, there was an ad in newspaper which draws a lots of flag because the ones who are registered with SEBI are tightly regulated while others are getting that kind of promotion. How do you respond to that?
So, I think there were representations made to us in terms of by the industry, and I think those have been addressed. And I think some clarification has also been issued by BASN to clarify that, and my understanding is that the matter is now settled. In terms of the ad, did not pertain to SEBI, so I have no views on it. I have nothing to say or add to that.
Yeah. Ma'am, one more just question regarding the exchanges. Ma'am, recently BSE and NSE has jointly made a release regarding the withdrawal of Friday Bank Nifty expiry. Now, ma'am, on one hand, you have issued a discussion paper where you have mentioned that, customers or the investors should get a choice between the exchanges. But now, in this case particularly, both the exchanges have decided among themselves or which expiry or which day. I mean, what is your view on that?
So, in our view, that's actually a very mature and a sensible approach, because at the end of the day, what benefits everybody and the entire ecosystem is diversification of risk. See, at the end of the day, today, everything is technology driven. And if everyone's position is concentrated on a particular day, it just increases the concentration risk of that day. And whatever may be the event that may happen on that day, it could be a cyber incident, it could be a failure of something, whatever may be the effect, the concentration of risk is never a good thing. So according to us, the two exchanges sitting together, reconciling this, and interest in the wider interest of saying let's have risk diversification in the market, and in the long run that helps everybody. We think it was a good move that they made.
Yeah, we'll come back. Jayashree, please. Please be brief in your question so that we can do it faster.
Ma'am, just a clarification to the disclosure requirements for offshore funds. The privacy laws waiving off is still a part of the final cleared proposal, because it's not in the release, that's why I'm asking.
Sorry,
the waiving of privacy laws, is it part of the finally cleared norms?
Yeah. No. That they would need to
waive off the privacy rights.
Yeah, they would. That's what I said, that as a contract, they're now saying we are agreeing to waive off our privacy laws so that we are now no longer bound by the privacy laws of our domicile. We are saying we will give you this information.